starting your business, you sort of have to visualize where you think you're going to go and start thinking about what is the legal entity that I want to create based on where you think you're going to go. It starts there because banks want to look at a history of financial performance, and if you started as a sole proprietor and then you decided to become an LLC or corporation, they're not going to look at any of the history that you had as a sole proprietor. So it's really important to do a business plan, and I'm a big proponent of a business plan, not because it's a document you need to show the bank or an investor so much as it forces you to sit down and really think about what you're going to do. And I don't believe in big, thick business plans. I believe in very short, precise business plans, but I do think a business plan should have these 5 elements to them. I think you need an executive summary that's no more than a page or a page and a half. You need a market analysis, and the reason you need a market analysis is it's going to force you to sit down and think about what the potential is for your business. You know, if I'm going to make widgets and there's only 100 people in the country that are going to buy that, then you might want to think about doing something else as a business. So it's really important to sort of see what the landscape is, see who the competition is. And you know, if you find there's a lot of competition, don't let that scare you, because if a lot of people are in that business, there's a reason for it. You just have to find a way to differentiate yourself. In fact, it's actually a little riskier to go into something nobody's in, because you got to sit back and say, why is nobody doing this? Because a lot of smarter people than I am have probably already analyzed and figured out there's not a huge potential for that business. So then once you do that, you want to develop your marketing strategy. Okay, so how are you going to differentiate yourself? How are you going to sell it, and who's your customer? Again, you're doing this not so much for the banks or the investors as an entrepreneur. It really does force you to sit down and think about how you're going to execute. And then the key is the financials. For me as a banker, I can tell the biggest mistake entrepreneurs make is discounting this, because entrepreneurs are marketing people by nature. They have a million ideas. They don't want to be burdened down with the numbers, but so they come to a bank or an investor and they haven't done their homework. They haven't put the financials together from day one, and it will crush you. I mean, you have to day one start your financial discipline. I think what you want to do is you have to have an income statement that identifies revenue sources. And again, this is almost for your own self-discipline. You know, how are you going to generate revenue? I got a great idea. Where's it coming from? You know, by doing an income statement, it forces you to identify the sources of revenue. And then the expenses are also you know, critical, because the other thing that a lot of people do in projections for their marketing plans or business plans is they underestimate the expense that they're going to incur. And the accounting costs, if you're not going to do the accounting yourself, you're going to have to hire somebody to do it for you, and that's an expense that a lot of entrepreneurs don't think about. All they think about is the marketing expense. I mean, I've seen business plans that are 60 pages long, and I can tell you nobody reads them. They'll skip to the financials. They'll read your executive summary and they'll skip to the financials. And the other thing about the financials is nobody believes a hockey stick pro forma. So when you're projecting out your financials in a business plan that somebody else might look at, if it looks like this, it's not very realistic. You know, you need to do the homework of how am I going to price my product. What are the expenses that are going to creep up on me I'm not thinking about? And be really honest about it. And if you're going to show losses for the first year or 18 months, then show losses for the first year or 18 months. Your business plan is kind of a living document. It's going to change. Believe me, it's going to change probably every 3 to 6 months while you're building your business. So it's just a good discipline at the beginning to get your head straight. And also, if you want to try to get investors, and eventually a bank, then you've already got sort of the framework that you're going to then build on when you go to approach these people. So now I'm going to talk a little bit about where you're getting your money. And you really have to start with friends and family. I know you've heard this before, but you can't go to a bank and get a loan unless you've got a tremendous amount of personal net worth. You've got to rely on friends and family. So you need to structure it just like a business. You don't just get, $1,000 from Uncle Joe. You really need to create agreements that you can, spell out exactly what they're going to own, and that they're really a limited partner in this business, or they're going to have limited units or shares, and that they have a complete understanding that they could lose 100% of their money. There should be no doubt that they are investing in you with 100% risk. When you're a small business and you're starting out, you can borrow money personally, and then what they would do is you can loan the business the money. If you borrow personally, you loan the business the money, you structure a note. Banks are usually going to want collateral, and for a startup business you don't have collateral, so what they're going to do is take a second trust on a mortgage or your house. And if you don't have a house, it's going to be incredibly difficult unless you have a lot of liquid assets that you can secure the loan with. So it's just really difficult to get a bank loan when you're starting out unless you have some personal net worth or you have a lot of equity in your home. If you ever go to get like angel money or venture money, you're going to have to prove to them that you've exhausted that avenue first. I mean, that's like the first thing. They're going to say, okay, how much personal skin do you have in the game? How much have you already gone to friends and family? Is that already an exhausted avenue for you? So if down the road you think that's where you're going to go, that's usually, not always, but that's usually a criteria for somebody that's going to invest in you with accredited money or other kinds of equity. So, of course, the other option is credit cards, which I'm not a big proponent of because the rate's outrageous. But there have been a fair number of businesses started by on credit card debt, which is certainly easily accessible but outrageously expensive. Another potential financing source is vendor leasing. Now, you want to own a gym. One potential way to get money is that the people that are going to provide you equipment will provide you the financing for that equipment as well. So depending on the business that you're in, you can try to negotiate vendor financing. I know a friend that started the self-serve yogurt in DC, and he arranged for his franchisees to get vendor financing for all the frozen machinery that they have. So it might cost $300,000 to start one of these franchises, but $200,000 of it is the equipment, and the vendor is going to help finance that for them. You have to have 2 to 3 years of historical performance to even approach a bank for bank financing for your business. I talked a little bit about you can get personal loans based on your personal net worth, but to actually get a business loan based on your business's performance, you need 2 to 3 years of results, and that's why it's really important you have those tax returns and you have income statements that you can produce interim statements for, because the bank's going to ask for all of that. You can do some startup businesses with SBA loans, but believe it or not, it's not as easy as you think. And they're going to take personal, no matter what, whether it's SBA or not, you're going to have to personally guarantee almost every business loan you do until your business is so profitable that you can negotiate that away. In the case of the SBA, if you own a home, they will take a second on that home, period. People that invest in equity, though, do expect a higher return. So if a bank loan is going to be 5 or 6%, people that invest equity in you want probably close to 30%. So it's a very expensive form of financing. But for a lot of pre-revenue companies, it's the only option that you have. One of the angel networks that hopefully is coming to talk to you guys is at the Bingham Center at the University of Maryland. There's other angel networks throughout this area, and where you live, I'm sure there are similar. They're often associated with local universities and the tech communities. The nice thing about angel investors is they'll go lower than a venture capital firm. Like, you could probably get angel money $25,000, maybe even less. Whereas venture capital firms, they really want to invest at least $500,000 to $1 million. The key to getting venture money is the networking. Like, if you went to college with somebody that's part of a venture firm,